Hey guys, hope everything is going well. You guys know that drill. Smash that like button, subscribe if you haven't, and comment down below. Follow me on Instagram at AIH_sports. All right, I have a few autographs to show you today. It's 1970 tops, number 466, Juan Marichal, right hand pitcher for San Francisco. I really like this auto. It's under 30 bucks, not bad. Here's another one for 30 bucks, postcard. It's PSA authenticated of Mr. Marichal. This is pretty nice. Hall of Fame guys. They're still alive. It's cheap. It's the off season. So, yeah, I believe that this is the way to go. Just look at things that no one's looking at. I may not make that much of a profit that I'm used to seeing, but ultimately, if I could get it under 30 bucks, I consider it a deal. I understand the supply may be high, but at the same time, I do believe that people will want to collect autographs for a long time, even though they're not culturally relevant. Anyways, today I want to get into a topic, and I understand some people may not be interested in it because it is regarding more of an economics topic. So I'm just give you a heads up. It's about inflation and whether it's a good hedge or sports cards are a good hedge against inflation. And I just want to give you background. I could go back to the 1970s just to recap. So if you look at the 1970s, we could look at the US came off the gold standard in 71 under Nixon. And at the time, what happened was gold prices were allowed to freely float, the US dollar was allowed to freely float, and we saw a depreciation of the US dollar in that decade. We saw gold prices go up, we saw commodities go up. The stock market was actually sideways during that time. There were booms and busts. It basically went nowhere. And sports cards went up. Other collectibles went up, and this was during an inflationary environment. And this is supposed to be expected because sophisticated investors, what they do is they see inflation, they want to put it into assets that historically have done well. And some people chose gold, some people chose commodities, and some other people decided to get into the collectibles arena. So it did well. 1980s was a little different in the beginning, and I showed you when the interest rates went up like crazy, the sports cards started to go down, collectibles went down, artwork went down. And it doesn't matter how high the interest rate is. Once again, it has to deal with positive rates versus negative rates. And I saw someone say that about the 1990s, you want a 5% interest rate, that'll crash the whole thing. What I'm saying is if they raise rates even like the 2%, 3%, that could definitely hurt our economy in the next few years. Now, that seems crazy, but ultimately, it always has to deal with positive rates versus negative rates in terms of inflation. And then you have to look at the yield curve, which I will get into in a different video. And I may start a finance channel and I may just go into some of these concepts and may look at some stocks, not as buy sell recommendations, just look at these things because it is one of my hobbies as well. Anyways, uh, going back to the 80s, you saw some beginning of the decade, collectibles weren't going anywhere. But then with the crash of 87, sophisticated money wanted to invest in sports cards, and it helped that interest rates were going down. And went from like 10% to what, 3% in the early 90s, and stayed there for a while until 1994, where they jacked up rates. And that's when the not whole system, the sports card market just went under. And if you look at then the 2000s, you had some inflation because you saw oil prices go up. So some people park their money in collectibles, it gradually went up. Okay. The reason why it didn't go crazy is because the concept, once again, of positive rates versus negative rates. The rates were positive, looking at the 5 year tips or the 10-year tips. I know these concepts may be, foreign to some people. I'll do more videos on this, and you can see some of my other videos on inflation and interest rates. So, yeah, over the last decade, you had quantitative easing, so you had a steady appreciation of sports cards. And it didn't go crazy until the last few years. But here's the thing. You could look at some of the high-end sports cards, they have definitely kept up with inflation. But now looking at the rest of the market, you could look over year, 2021 versus 2022. The sports cards have gone down, and we can definitely agree on one thing. We've had crazy amounts of inflation, okay? And over the past year. So inflation went up, but sports cards, for the most part, unless you owned a Tom Brady rookie card that you bought, I mean, like a Tom Brady card just went up for the most part, unless you bought at the Super Bowl high. Anytime after that, Brady cards have been going higher. So besides just a few of those cards, most of the cards have not kept up with inflation. But then people may look at, hey, look over the past few years. Yes, that's true. Over the past few years, sports cards have definitely gone up. But you have to remember, a lot of that buying pressure, as I mentioned in my last video, was in 2020. And a lot of people are definitely underwater. Not all, like the game of musical chairs. Those 2 people out of 7, those guys are fine, but the rest are probably not doing so hot. It could be 3. I just threw a number in there. But regardless, a lot of people underwater. You could see in the comment section, you could see it in sentiment, etc. Granted, if you were just to look at it from an unbiased perspective, people would be like, okay, this is strange. You had inflation go up, but sports cards go down. So, what does this mean? It just means that just because you have an inflationary environment, it doesn't mean that sports cards will go up all the time in that environment. Some people may say, hey, look, you're looking at a 1 in 100 year event with this pandemic, and it totally screwed the pricing mechanism of this market. And yeah, you could say that. To remember 2020, the prices just shot up like crazy because we didn't have any sports to watch, right? We didn't have any entertainment. So people took their stimulus money, they just poured it in there. And then you had private equity with the low interest rates. They saw, hey, this could be an opportunity. So they started to pile in. So then more people started to pile in as well because everyone thought it was a get rich scheme, but it wasn't. It's like the FIFO concept, first in, first out. If you got in early, you could just sell. You could sell it in 2020, 2021, 2022, and you'll be fine if you bought early of a high graded quality card, as long as it wasn't a fake. Now, if you just want to look at the future, I expect the trends, though, will go back to normal. Okay, we're going to have probably a down cycle. We've already had a down cycle, but more room to the downside. A few years from now, you buy cards, and then inflation later on this decade, you're going to probably see a good opportunity where these cards hold up during an inflationary environment. Now, the only caveat that I see is that if you have another lockdown, I mean, I listened to some of these tinfoil hat people. They said they could have lockdowns regarding X, Y, or Z. Okay, if that happens, if you have those type of lockdowns, and they give UBI, Universal Basic Income, you could potentially see a similar type event. Now, would they shut down sports? No, but you could see more of an increase than we've seen in the last year. And who knows, Fanatics may be doing great at that moment. But yeah, so long story short, in a normal environment, sports cards should be a decent hedge against inflation. And obviously, the card needs to be of a quality player, high grade, and all of that. Not some mid, it's not some guy who goes to the All Star a few times. People may chase that, but a good long term hold would be a quality player. And it seems that 2021 and 2022, what's happened, and you could say maybe in the next year too, where we'll still probably have inflation, they're not going to be a good hedge against inflation if they were to buy at that moment near that top. And you could say it's an aberration because we went through a pandemic and the circumstances were much different. And then you could also say that the supply of cards was exceeding the demand. You have to remember, demand went down for the sports cards because PSA shut down. So less arbitrage opportunities with the number one authenticator in town. And two, the economy was opening back up. So less demand because now you could go out, you could go to the theater, you could go to the bars and restaurants, and there's no limitations, etc. Or there's no restrictions. And yeah, we're going to see the same thing happen in much of America. Restrictions are going to go away. People are not going to be scared. Less money for sports cards. So it basically comes down to now, if you can find a player that exceeds expectations, those are going to be decent holds. But the concept that it's a good hedge for inflation, if you had bought in 2021 for the most part, not really. If you bought in previous years, I would say that, okay, you're still doing fine. 2019, 2018, 2017, yep, it's a decent hedge for inflation. But anyways, guys, let me know what you think. Smash that like button, subscribe if you haven't, comment down below, guys. Thank you. Bye.